deals with how we actually get paid. It's great we've got this e-commerce site set up, website, everything's working excellent, but bottom line is we need to make an actual financial transaction. So common online payment methods, cash not so much, checks not so much really. The majority is going to be credit cards or debit cards. And more than 90, that accounts for more than 90% of all the U.S. consumer payments. There are other things like electronic transfers that are a very small percentage. Predominantly, people are using credit cards or debit cards. Now, as the author states, and this number I think is shifting some as we go, more and more people are going to things like PayPal for some security reasons and getting away from using actual credit debit cards. The author shows a chart here. Again, I think this information probably needs to be updated in the textbook. I would say things have probably shifted a little bit more on that. Store branded cards probably have gone down. Prepaid cards probably have gone up. And I would say definitely the alternative methods like PayPal will have increased. So retailers may offer their own store charge cards. These are really falling out of favor for a couple of reasons. Most notably, first, you can only use it at that particular store. And second, the interest rates charged on store cards are usually very high, a lot higher than you could have with your regular bank credit card. So those are really falling out of favor. And what we're seeing, though, has increased a lot is the use of prepaid cards, and those are being used as gifts. In some respects, yeah, it's easier. You let the person go and buy what they really wanted. Personally, I don't like those kind of cards. I would rather have someone take the time to go shopping for me for a gift, and then if I don't like it, yeah, I'll take it back in exchange. But somehow getting a store gift card just seems like, gee whiz, you didn't think of me enough. You just swung by the grocery store and picked up a card on your way home. Anyhow, just my personal bias. Single-use cards are an interesting concept. I'm really disappointed that they didn't take off. Basically, a single-use card is a disposable charge card number. You create it, it's generated by your bank, your credit card company, and it can be used for one transaction. Once it's processed once, that number is no longer valid. The beauty of that is it doesn't matter if someone hacks into, Fred Meyer's system and sees, oh, I used that credit card number 1234 because credit card 1234 was good for one use only, and if they try using it won't, nothing will happen because the one-time use is expired. Again, I'm sorry that more people didn't embrace this, and so now most card companies don't offer it. I believe there is one credit card company that may still offer it. So anyhow, going on to it, interesting thing, this is by law in the US. Once you put a charge through on the card, you have to ship within 30 days. And so be careful if you're going to actually charge someone's account. You need to make sure you've got the inventory that you can ship. Ideally, I would say you don't charge their card until you actually ship the item. Now, one of the key concepts to understand in electronic commerce and how we get paid is a two-part process. The first is when someone wants to purchase something is to establish the validity of the card number and that the transaction will not exceed the limit on that particular card. That occurs, virtually real time when you process that either at, at a physical brick and mortar store or you click the checkout on a website. The next step, clearing the transaction, is when the funds actually move. When you make that online purchase, nothing happens. No finances actually go from one account to another. It just reserves some money, and then later the transactions will actually occur. And so we'll see that here in a minute. The author has some charts, and we're going to watch a video that goes into it a little bit more so you see how the money actually flows through the system. Two types of credit card processing are out there, what's caused an open and a closed loop system. So a closed loop system, the card issuer is directly involved and there is not another bank or clearinghouse involved. So examples of that are American Express and Discover Card. In an open loop system, there are other intermediaries inserted into the process. So you have Visa and MasterCard don't actually issue the Visa and MasterCard accounts themselves. Those are issued by particular banks. For example, my Visa card was issued to me by Wells Fargo, so they're inserted into the loop. So here's the author has a diagram of the simple where you have the actual card issuing bank is the organization that's issuing it. There's no one else involved. That's the closed loop system, as opposed to the open loop system, where as you can see there's a number of other entities involved in that. So let's watch a YouTube video and just see to try and clarify a little bit the role of the merchant bank, acquiring banks, issuing banks, and how that all works together.
Are you having trouble understanding your merchant account? Are you confused about the rates and fees and how you're being charged? If so, this video will explain how it all works. You don't need to know every little detail about credit card processing. You just need to know enough to delegate the task to a provider that'll take care of everything for you. Nevertheless, it's important to understand the fundamentals so that you can properly make a provider selection. In the next couple of minutes, we'll discuss the merchant account transaction cycle and how it works, interchange and its role in the process, the two main pricing structures and how they compare to each other, and at the end, I'll give you a couple ideas on how to best select a provider that fits your needs. Let's look at the transaction cycle. First, the customer presents a card to the merchant for purchase of goods or services. After the card is swiped or entered into the point-of-sale software, the processor sends out for authorization through the payment processing network. The issuing bank approves or declines the transaction based on funds available. The transaction is then passed through the electronic networks to the processor, and the approval code is delivered to the point-of-sale device at the merchant location. The issuing bank then sends the money to the processing company to reimburse them for the purchase that was made. This whole process is completed in just a matter of seconds. At the end of the day, the merchant will send out all of their transactions, referred to as a batch, to the processor for monies to be deposited into the merchant bank account. And finally, the issuing bank will send the cardholder a bill for the purchase. What is interchange and what role does it play? Interchange is a schedule of fees that determine the price for all credit card transactions. There are hundreds of interchange levels, and each is comprised of a set of qualification requirements that must be met in order for a transaction to fall into a certain category. The two main qualification requirements are, number one, how the payment is accepted, whether it's face-to-face or over the phone, for example. And the second is the type of card that is used, whether it's a consumer card or a business card, for example. Individual rate categories are set by Visa and MasterCard, and the interchange schedule of fees are published and could potentially change 2 times per year. This is important to remember since those changes can affect the cost of your merchant account. Here's a sample of just one part of a schedule of fees published by Visa. As you can see, there are 13 rates and 8 categories on this example alone. Again, in any single transaction, just one of these rates are charged based on the qualification of the card that was presented. Let's look at 2 main pricing models and the components of both of them. Most providers will offer the following price structures. Number 1, tiered pricing, also known as bundled or bucket pricing. And the second is Interchange Plus, also known as Cost Plus or Pass-Through pricing. In order to compare these 2 pricing models, let's first look at how the 2 pricing structures are related. First off, interchange costs are at the core of both pricing models. The fees for any given transaction are broken down into 2 main categories: interchange costs, along with dues and assessments, and processor costs. Dues and assessments are paid to the card networks, which is Visa and MasterCard, and are the same for everyone as are interchange costs. They are absolute, and every processing company pays the same amount for interchange, dues, and assessments, period. They cannot be changed or discounted for special situations or for any reason, so whether you're a Fortune 500 company processing billions of dollars each year or a hobby business with just a couple $1,000s in volume, you pay the same fees. From now on, when I refer to interchange, it is assumed that dues and assessments are included since we understand that they are the same for everyone. The processor cost is the one variable that differs from one processor to the next and is the only area open for negotiation in your search for a merchant account provider. Here's both pricing models in detail. Your choices are tiered pricing or Interchange Plus. Tiered pricing takes hundreds of interchange categories and lumps them into bundles or buckets. The 3 common tiers are qualified, mid-qualified, and non-qualified, and as you can see from the chart, the rates increase as you move from qualified to non-qualified. Each of these tiers are set and assigned a specific rate by the processing company and can vary from one provider to the next. In fact, they often do. What is considered to be a qualified transaction with provider A might fall into a mid-qualified transaction with provider B. Tier pricing sorts the hundreds of interchange categories, and each tier is priced high enough to cover the average of all of the rates and fees that fall under that tier. Interchange Plus pricing passes the actual interchange costs through to you, and a small provider charge is charged in addition. Also referred to as provider markup, this fee varies widely based on a variety of factors and can range from 5 basis points up to 1.5% or even higher. Here's a sample transaction. Refer to the Visa interchange chart that we looked at earlier, and let's compare a single transaction at a qualified rate of 1.79 under a tier-based program to an Interchange Plus pricing program with a processor cost of 20 basis points. Assume the following for the transaction. The interchange cost is 1.65% plus a 10-cent transaction fee, and we'll use a $100 transaction as the sample dollar amount. Given those 2 variables, we know that the actual cost of the transaction is $1.75. For the Interchange Plus pricing model, you have a 20 basis point provider cost added to the $1.75 actual cost, bringing the total to $1.95. For the tier-based pricing model, you have that same base cost of $1.75, but in order to get the total cost for a tier-based pricing model, you simply multiply the $100 times the 1.79% rate assigned to that tier level to get the $1.79 total cost. As you can see, interchange cost is at the core of each of these pricing models, and with any pricing model for that matter, and is paid one way or another. So in this example, you can see that with the Interchange Plus pricing model, your total cost is $1.95 compared to the $1.79 with the tier-based model. In either example, you can see that only a small piece of the total fee is paid to the processor, as most of the fee is sent back to the issuing bank. Provider costs are collected for the purpose of paying network fees and other general business costs, such as administrative expenses associated with account servicing, application approval, and costs related to licensing the electronic payment networks. For each transaction, this same calculation is done depending on the pricing model that you're currently paying. It's widely assumed that Interchange Plus pricing is a better pricing model because it's said to have a true cost or a transparent pricing model, but does not necessarily mean that it's a lower overall cost. Variables such as average ticket and the number of transactions processed each month, in addition to the pricing structure variables that we discussed already, determine whether tier or Interchange Plus pricing is best for your company. Merchant account pricing is not one size fits all. In the end, what matters the most is the total dollar amount in fees paid for accepting a certain dollar amount of credit card volume. If you're interested in more tips, advice, and ideas on how to best structure your retail or e-commerce merchant account, head over to bankcardsales.com and look for the Definitive Merchant Account Guide. It's a comprehensive solution that gives you everything you'll need to set yourself up with a merchant account that works for you. And remember, you don't need to know everything, just enough to make the right decision for you.
So I know that was a lot of information, and why I let the whole video run is to show you that there's a number of choices you have to make when you're setting up your merchant account and deciding who you're going to use to process your transactions, and it can affect your bottom line. You want to pay the least amount in fees as possible. So with that, when you're getting your business set up and going, you need someone that can help you and guide you through that. Typically, the organization where you're hosting your website, they may have an arrangement with merchant accounts, and there's other people that can give you advice and counseling as to what's going to be the best for your business. So you do need to get that merchant account set up when you want to start doing business online. That's the first thing you've got to do, is work with your bank and get a merchant account set up. To do that, your bank's going to want to know about your business. They're going to assess how much risk it's going to be in doing business with you, and they'll make a determination whether they're going to approve to set you up as a merchant. Now, one of the reasons why the bank wants to know how financially solid you are is the whole concept of chargeback. So a chargeback occurs when the cardholder contacts their bank and says, hey, that charge listed on my account is fraudulent. I did not order that item. That was someone else. And so then the bank agrees and they refund the money to the person, the cardholder. But the bank doesn't get stuck with the bill. They come to you then and say, hey, the person on the other end says they did not authorize that charge, and you're going, but I shipped the item, and their bank is saying, we've determined that the person did not make that order. It was a fraudulent order. And so then the bank will charge you for the amount that they had credited you for the order, because the bank's not going to get stuck with the bill. You are. And then you go, so you have to refund the money that the bank gave you, and you're out the merchandise. So it comes out of your pocket. And so again, as the video said, you got to pay for the service that those organizations are giving you for processing that information, that financial transactions. Now, fraud is a problem. And as I mentioned, unfortunately, you as the merchant are the one that pays for it. And, it's interesting here that a lot of the, like most things, a few of the credit card transactions are responsible for the majority of the dollar amount that's lost. So that indicates it's the big ticket items. Now, there's been an interesting trend going on where the fraud is occurring with smaller amounts. And I think one of the reasons for that is that the smaller amounts go unnoticed and people don't challenge them as much. If it's a small amount, they may not recognize it, where I think any of us would, if we saw a $1,500 charge come through, we go, wait a minute, I don't remember authorizing anything like that. So one of the ways that the credit card companies are trying to prevent that fraud from happening is, let me back up there a minute. Yeah, there we go. Using, of course, the CCV number on the back of the card, that helps, but shipping only to the card billing address also helps. Now, another thing that happens is the banks are monitoring my normal ordering. And so if they look in the past year, everything I have ordered in an online transaction has been shipped to my residence in Oregon. And then they see a transaction that has a ship to address in South Carolina. They will flag that as suspicious and then contact me and say, hey, did you order something to be shipped to South Carolina? And when that happens, a lot of that times that's fraud. And I've had that happen a few times where the bank has called me and said, did you order something? And I'll say, no, I did not. And so they stop the transaction right there. It's not approved. The merchandise doesn't get shipped. The bad guys don't get their information. And it tells me that my credit card information has been stolen and I need to cancel that credit card and get a new one issued. And so banks really are trying to reduce the fraud and keep a handle on it. And unfortunately, the bad guys keep getting more sophisticated in their methods of stealing. Another term that you may hear talked about, the automated clearinghouse, ACH. And these, as the author points out there, it's just a set of banks that are involved in direct deduction transactions. So sometimes you'll see that on your bank statement. It'll say an ACH transaction. That's what that means. So depending on the size of your business, just like we've talked about before with implementing your web and everything else, depending on the size of the business determines how much you do in-house versus how much you rely on others. I strongly recommend, as you're getting started in your business, to don't do anything yourself. Contract everything else out. Yes, it costs money, but you've got more important things to do with your valuable time or your very limited time. So now let's talk about digital cash or cyber currency. Bitcoin is certainly the one you've heard the most about, but it is by far not the only one. There are dozens of cryptocurrencies that are out there right now. And there's a number of issues. The whole reason that cyber currency was developed was really to facilitate illegal transactions that the criminals don't want there to be any way to trace the flow of funds from one organization to another. Some people have jumped on it as seeing, wow, this is a way that we can bypass governments and we don't have to worry about currency fluctuation. And there have been a lot of people who've gotten really excited about this, but there's a lot of concerns. The security, and privacy, That's a challenge with this whole thing in cryptocurrency, and really we're on the very beginning phases of cryptocurrency. A lot of issues have not been worked through. Legislation that is there to protect individuals with, like fraudulent bank transactions. Legislation has not been updated to reflect cryptocurrency. So if someone fraudulently transfers out of your cryptocurrency account, right now there's very little, if any, legal recourse or anything you can do about it. It's just gone. It's like having cash laying around. You turn your back and someone walks away with the cash. What are you going to do? You're out the money. And that's kind of the way it is with cryptocurrency. So really, my recommendation right now is don't get involved with cryptocurrency. There are just too many questions that have not been addressed. And, like I said, you need to be focused on growing your business. Let someone else cut their teeth on cryptocurrency. We'll see where it is 5 years from now, maybe not, even for 10 years from now, if it becomes an established, stable, and safe means of transferring value from one person to another. Something, however, you do need to really be aware of and invest in is this concept of digital wallets. And what I really like about the digital wallets is that it gets rid of credit cards, the physical devices. And it really adds an increased layer and level of security to prevent fraud. So some of the common ones that you'll see is Apple Pay, Samsung, Android Pay, and PayPal. The advantage, because we have this issue with security breaches that can reveal thousands of users' personal information. But by using Apple Pay, or Android Pay, these other devices, it really prevents the criminals that have access to that information from doing anything with it. Because if the criminal doesn't have the wallet software installed on their computer with your particular digital certifications, they aren't able to complete a transaction. Even if they've got all the information about your account and everything else, you have to have additional encrypted information in order to make the transaction. For example, I use an access for my investment accounts. It doesn't matter if you know my account, if you know my username and my password. When you try and log in, it's going to ask for a 6-digit code. Well, that 6-digit code changes every 30 seconds. And it is synchronized to my smartphone. And so unless you also have my smartphone, you won't be able to, you have no way of knowing what that 6-digit code is. And by the way, my smartphone is encrypted and I have a password on it. So even if you steal my smartphone, it's not going to do you any good because you won't know the password to unlock my phone. And so there are ways that we're trying to get a lot smarter in how we protect things so that even if someone breaches a database and gets access to that information, it doesn't do them any good. Okay, so at this point, let's pause for a moment. The password for this chapter's quiz is Gateway, and you will need that again to unlock the Chapter 11 quiz. Okay, going on. Believe it or not, paper checks are still the predominant way that financial value is transacted from one person to another. Part of that, even within the US, it's still a large contribution. Certainly as we get outside of the US, some countries, regions are less digital in their whole infrastructure. People don't have access to the internet in the same way, and so paper checks are preferred. So it still is a big part of the transactions that occur, especially in face-to-face brick and mortar. And other major payment forms involve banks, and certainly as the internet is advancing, we're getting new tools and also at the same time creating new threats to the banking industry. So one thing I did want to mention, the author brings up the old method of physical check processing. You wrote the check, it was the retailer took it, and then the retailer sent it to a clearinghouse that sent it to another place, and eventually that paper check gets transported to the merchant's bank and then all the way back to my bank that I wrote as the purchaser, and finally the funds all transfer. Now, the disadvantage of that, of course, is you're shipping checks back and forth all around the country, potentially. If my issuing bank is on the West Coast and I made a purchase on the East Coast, and that introduces a fair amount of delay in time from when a check is written and when it clears, when it is actually the funds transfer. And so that's why historically it was, if you deposited a check, you wouldn't have access to the funds for anywhere from 3 to 5 days. That's called float. But back in the federal government made changes to the banking laws, allowing banks to use scanned images of the check instead of physical pieces of paper. And that really makes it possible to instantly transfer the funds. And so there is no need for a delay. Unfortunately, you'll still notice that depending upon who you bank with, if you deposit a check, you may not have access to all of the funds immediately. They may be generous and allow you to have access to $200 or $300 of the amount initially. But to get the rest of the $2,000 check that you got deposited, you have to wait some time. Well, the bank is taking advantage of your money. All the transactions are happening in the banks instantly, electronically, and so there's no need for that delay. But there's still a lot of banks not giving you instant access to the full amount. So mobile banking has certainly taken off. I would update the textbook to say banks are not exploring mobile. Banks are engaged in mobile banking in a big way. They've recognized that the advantage of mobile banking is that they can free up their employees, because now I don't need to go to the bank for all these transactions. A lot of things I can do with my mobile device, and therefore I don't have to have as many bank tellers. I may not need to be open quite as many hours, stay open as late, because so much of it can be done online with my mobile device. So some of the things that banks with their apps offer, one of them is helping you find an ATM that's close by, and certainly transferring balances between your accounts, very simple to do. And most bank apps allow you to deposit a check by taking a picture. We're back into that change in the banking laws that allow the banks to use scanned images, and now the banks are allowing us to use scanned images, so that there's no reason for us to go into the bank or to go through the drive-through teller to deposit a check. We just do it from our smartphone in the comfort of our own homes. Now, another interesting thing that developed a few years ago, Square really recognized, I guess that was the word I was looking for, some of the features of the iPhone and Apple's tablet, that they could use the headphone jack, which originally the headphone jack, it's, to plug in your earbuds, your headphones to listen to music. And they also had a input there for a microphone. But they realized that the way Apple had designed that particular input-output part of the iPhone is that it could accept digital information. And so they created this little thing, a little white square that plugged into the tablet headphone jack or the phone headphone jack, and would allow you to be able to swipe a credit card, the magnetic strip, through the reader, and it would transmit the information through that headphone jack. And then the app, the Square app that was installed, would be able to process an electronic transaction. It was a brilliant concept. They recognized that while I don't think Apple ever intentionally designed that jack to be able to be a digital input device like that, they recognized the features and the possibilities of it and really created a whole new way of doing transactions where you're not tied to this big bulky cash register. Instead, you've got a mobile device that you can use for processing information. So very innovative, and Square and of course others have similar products now. One thing that should talk about is we're talking about e-commerce is, and I've already mentioned it a little bit, there's a lot of criminal activity associated with this. And the biggest one is phishing. And what phishing is, it's an attempt to get you to reveal information that you shouldn't, information that allows the criminal to make a fraudulent charge. And this is a big problem with financial institutions. And a lot of times the phishing attack may look like it's coming from your financial institution. It looks like an official U.S. bank or Wells Fargo or Chase, Bank of America, and they have all this, official language about, we need you to make sure that your account information is up to date for security reasons, and they'll have links in there about how important security is and everything else, and it's all a bunch of fraudulent false statements. They're trying to get you to click and go to a site that is not Bank of America's site, it's the criminal's site, where they will then ask you to confirm your login information, and when you do that, they now are able to log into your account. You need to be very diligent and look for telltale signs that it's bogus. And there's a lot of ways you can recognize that. If with most of the email systems, if you hover your cursor over the link that they're asking you to go to, it will display what link it is actually being directed to. And if it doesn't look like your bank's email address, contact the bank and say, hey, I just received this message. Can you confirm that it's legitimate? And they'll be able to tell you whether or not they sent you communication. So just be careful. Anything like that where they're asking you to confirm security information, be very suspicious. And that's the highlights of Chapter 11. Make sure you've read the full text. There's a lot of good information in there that we didn't have time to cover.